once if you know that these flexibilities are required, you need to tell your advisor at the start so you can build it into the design of the policy, so that if in future you can't really pay up to 100K anymore, you can actually reduce it to say 20 or 30K. It depends depending on how it was designed. Now, both of them can be corporately owned. Both of them will last for your whole life, right? So that means it will outlive you. Okay, um, both of them are pretty good, right? Then the next thing is, can permanent life insurance be a wealth strategy? Of course. Force is one of the best wealth strategies. That's why if you go and look at the asset declaration of Joe Biden's asset declaration, I think it's online. You would see Joe Biden has six whole life policies. And if you scroll down, it has six whole life policies from Mass Mutual. If you scroll down to the liability section, you would see Joe Biden has you'll see a line there that says loans taken against the cash value of policies. If Joe Biden can do that clear, we can do it as well. So, permanent life insurance offers you tax-free growth, which means you're growing money without talking to CRA. Tax-free retirement, right? You can structure it in such a way that you have a retirement where you don't pay tax. Why? Because you don't have any income. You only have cash flow coming in, not income. Now, corporate ownership, you can own it in the corporation, you can also own it personally. And of course, collateral financing means that you can use it as a collateral to get money to fund other ventures, other endeavors. So the next thing is the next question was what corporate health insurance options are available. You have health spending accounts, you have critical illness insurance, you have disability insurance, you have group benefits plan also. Now, all these plans are unique in different ways, right? And these are things that as a doctor, they need to be part of your suitcase. Now, the one I want to really talk about because it is also a tax strategy is critical illness. Critical illness is a very popular tax strategy, right? And I'm beginning to observe that it's finding a lot of favor amongst Muslim clients, right? Because um, because like few of them have told me it aligns with what they believe. So what this policy does is simple. You as owner of a corporation, if you make $600,000 a year, that means if you were to have a diagnosis of something or go to a major surgery, you would like to take time off work. So what are the kind of illnesses that are covered? Critical illness insurance provides a lump sum payment to you in the case where you are diagnosed of one of these 25 covered illnesses. Like you guys know these illnesses way better than I do. I can't even pronounce some of them. But but you just with diagnosis of these things, money gets paid. But the difference between what we have here and what you have over there is this. And what you have outside in the UK is this. In the UK, you pay these premiums and it goes one way. It's an expense. But here, you can claw back 100% of your premiums if you end up not using it. And this is how it works. So the corporation buys this is an example. The corporation buys the policy and pays premium of $739, for instance. While the director or the doctor in this case buys what we call the rider, return of premium rider, and pays this. So both of them pay this, and then after like say 20 years, maybe after 20 years, you can cancel this policy and collect back all the money the corporation and the doctor paid. And this money can come back to you as tax-free personal dollars. So these are the things that you can use you know, to slowly strip corporate dollars and make it personal without paying taxes. So then the next thing is disability insurance. I think I've spoken about this. You just need disability insurance to cover your to cover your expenses. So if you make 10K expenses in the family and 5K in the business, you want to make sure that even if you get into an accident or an illness, you are able to sustain your family's bills and you're able to pay your medical bills. This is very important. The next thing is what we call, the next section is intergenerational wealth. Intergenerational wealth, a lot of people talk about it, only few people do anything about it. It is very important, and if you don't think it's important, I would say one thing. Would you have been happy? Would you have been happier if you received a windfall of $2 million when you became an adult? I would have, right? I don't know about you. So, intergenerational wealth is very important. So, it's a very important concept that we need to treat with all the importance, the all the attention it deserves. Now, I'm going to show you some tools. Number one is corporate life insurance is a way, sorry, life insurance, not corporate life insurance. Life insurance generally is the best way to transfer money to the next generation. The reason is because the death benefit of a life insurance policy is tax free. So if you have a house of $1 million and you pass that house on to your children, it's going to trigger taxes, except your primary residence. Maybe a rental property you want to pass to your child, it's going to trigger capital gain taxes. If it's owned personally, even if it's owned in the corporation, it will trigger capital gain taxes. But then, sorry, if it was owned personally, it will trigger capital gain taxes if you pass it on to your children. But then, if it was a death benefit of a life insurance policy, as long as the beneficiary is your spouse, your children, and your parents, these are called preferred beneficiaries, then that windfall is not subject to attack by creditors, it's not subject to attack by litigation, it bypasses probate, and it is tax free. It's a tax free windfall. Even if it is owned by the corporation, what happens is it can flow through from the corporation account to the shareholders of the corporation through the CDA, capital dividend account, tax free, a good portion of it. So, um, so life insurance is one of the biggest ways to transfer wealth from one generation to another, be it a personally owned one, be it a corporate owned one, or be it the ones that come under a bucket we call wealth transfer strategy. I'm going to talk about that in a bit. The other thing is the family trust and holdco. It is very important to have a trust, right? Even though the trust we have in Canada is not as robust as it is in the US. I know sometimes people watch things online, that is, speaking to US, people think it's Canada and they attribute the same things to. But trust is important, but then you need to sit down with a lawyer and understand the do's and the don'ts, the powers these things have and the powers their own limitations. Holding company is also good, right, for passing wealth because you are able to, you're able to assign shares to your children, to your wife, and also there's something called estate freeze where you can freeze your own portion of the shares and allow the future growth to go to your loved one. But that is too complex for this gathering. Now, RESP for your children sometimes is also a wealth transfer vehicle because you're buying RESP for your children. You can also buy RESP for your grandchildren also, not only your children. Right? Just so you know that. Now, and then the last part you want to talk about wealth transfer strategy. Wealth transfer strategy, in my opinion, is one of the most viral insurance products in Canada because it is very powerful. So, what happens is you buy a permanent life insurance, a whole life or universal life on the life of a child. Now, this is a real life example. Okay, you buy permanent life insurance on the life of a child. Why do you do it? Because number one, you want to guarantee the insurability of the child. Remember, you don't buy insurance, you qualify for insurance. So your child is healthy today. So you get in policy when he's healthy. So if that child's health was to change in the future for any reason, the child already has insurance and won't get declined by insurance companies when he wants to buy or he or she wants to buy a policy in future. So that is very vital to guarantee the insurability of your child. The other one is to get child insurance for this child at its cheapest. Other thing is to because the child is very young. Insurance is sensitive to age. So if you buy $100 policy for a 1 year old child, that same policy would cost maybe $2,000 for an adult. Now the other thing is um, um, It allows you to grow money for your children in a tax exempt environment because the RESP is limited. It's so much money, 50K max. But universal life or whole life can allow you to grow money tax exempt for this child as much as possible. And you can convert taxable assets to tax-free wealth transfer. Because if you just put that money in, in real estate, by the time by the, by the time you get to the point where you're moving that asset over to the child, it's going to trigger taxes. Now, but if you pass on the wealth transfer strategy to a child, it doesn't trigger any taxes. Okay. Now, it also minimizes erosion of capital during the wealth transfer because there's no taxes involved. So let me explain this case study, this example, so you understand. Now, a dad, oh, let's say a mom. So, so the parents bought a 1 year old policy for a 1 year old child. The parents pay $200 per month. They're going to pay for 20 years. Like, so they'll pay $48,000. By the time the child is 21, $48,000 goes in, policy is paid out. And by the way, you can also do this in one payment. And now the coverage is $1 million, and this example is based on universal life. So look at this. You pay $200,000 every month, and by the time this child is 20 years old, for instance, you can get as much as $100,000 sitting there. And this child can do so many things with these monies at any point in time. This child can do anything with these monies. They can access it for down payment. They can access it to support their education. They can access it for anything, right? And God forbid, if something was to happen to the child, there's a death benefit that comes in to the family, depending on when that happens, because, depending on when that happens. Now, if this child doesn't need to touch this money for any reason, by the time this child gets to 65, there is $4.5 million sitting there. From $48,000, you help your child to build up to $4.5 million. It's giving your child leverage, giving your child, that bump that will help them very much, right? And if something were to happen to this child, this amount gets paid at any point this happens. So if something were to happen when the child is older, then a large windfall comes into your family. So this is how the wealth transfer strategy works, based on the life of a child, paid for by the parents, and then when the child becomes an adult, you transfer the policy to the child, and the child will own it, and maybe the child can elect their own children to be the beneficiary. So, and then, I mean, when you come in, it's going to be a lot. Your first 90 days, you're battling with, trying to understand what's going on here in Canada and your work. But there are some things you need to make sure that you tick off, right? Like, opening your professional corporation, setting up a bank account, personal and corporate, making sure you get your driver's license, healthcare on time, you know, undergo a financial needs analysis fast. Once you come in, sit down with me and let me do your financial needs analysis. And when I do that, it's going to show you a roadmap of how you need to progress, the thing, how you need to proceed, because it's going to capture your goals, and those goals are going to be used, to compare with where you are to know exactly what gaps you need to close. And of course, you need to open FHSA fast, because if you don't open, you don't get the room. So if you not open, if you come in for 3 years and you don't open FHSA, and that means you've lost it, right? So open FHSA, TFSA, and if you are a PR, or then you can do RESP. If you're not a PR and your children cannot have the same number, and then you can do that. And then you implement all your insurance policies. Now, every month without the right structure is a month of excess tax paid, or compounding loss, or you taking a risk and retaining risk of something happening. The physicians who act fast in the first 90 days consistently build wealth, and significantly create, larger wealth. So, and then finally, right, I invented this. I call this Adautin curve, right? Adautin is my last name. So I invented this curve after working with so many physicians. The one that is still in the UK, the one who came here 30 years ago, the one who came 20 years ago, the one that's about to retire. I've seen it all, right? I'm the AI of doctor. I'm the AI of doctor because I've seen it all. And I sat down to understand the journey. That's why if you sit down and converse with me, you would see that I know what you're not ready for. But I will let you know this is what you need to know, but you're not ready for this yet. For now, based on where you are, this is what you're ready for. So this is what I use to guide this is what I use to guide doctors, based on where they are on what to do at every point in time. And this call shows you, okay, when you come in, I'll define what settlement means for you. I'll define what stability means for you, what accumulation means for you, what distribution means for you, and what data transfer means for you. So I don't want to take more time. I've already exceeded my allowed time. But thank you very much for listening to me. We hope that you know, we we are very busy, super busy, trying to contribute our part to ensure that the people, one of the best people in the world, who are putting their lives on the line, to make sure someone like me, is healthy and sound all the time. On behalf of Canada, on behalf of North County, I want to thank all of you for coming here. We don't take it for granted. That's why we put in the work to ensure that as you're busy keeping us alive, we are busy keeping your finances alive. I'm the financial doctor, and you can reach me through these numbers. You can scan this QR code to book a session with me, and I can, plots are super limited, but we are very committed to ensure that as much people as uh, as we work with, they get the very best there is to get. So thank you very much, and thank you Ade for for bringing me to speak to you guys.
Thank you so much. Thank you, thank you, thank you. I'm sure the best credence is the fact that no one left the room while you spoke. So you flowed, everything was spot on point, succinct, and all in our best interest. Thank you so much. I like giving people their flowers when they can hear it. Thank you.
Mm.
So I've got some questions right away, please. Thank you, doctors, for staying. I know it's a Sunday. I work 6 days a week. I understand how our rest day is, and I'm not going to abuse this access. We're going to take these questions back to back. He has given the number. Take a screenshot. I'm going to send a link to the WhatsApp group for people that are not here. And if you also want to use that, and for people that are registered, I've got your emails. If you give me consent, I'm going to share it with him. So, Mr. Charles, don't worry, we've got like a three-way process for you to get in contact with them. And
Okay.
it's a free session, isn't it? We like free things.
No, it is free. It is
Thank
free.
you. Thank,
Yeah.
thank you. All right. Thank you so much. Yeah. So the first question here is someone has said, is 500K gross income or net? So you've mentioned that we should, if we earn above 500K, we shouldn't earn, our corporation should not earn passively above 500K, or else we would lose the small business benefits. Now
That's a
he's
very
asking,
good question.
we have a
So,
lot of questions, so I want us to, yeah.
okay, okay, okay. So you earn um you earn 700, and you know what? I actually have a slide that really explains this in detail. Let me just show you this. It's
On,
better. It will make everyone understand better. So 500,000, which is net income in what you guys know as net income in UK, which means you've built 1 million. After overhead, you have 750 coming in, right? And from that 750 that comes in, you have business expenses, clinic rent, and all of that, and your salary of 350. If you understand, 750 minus 350 is 400. So that 400K is your active business income, and that's what
mhm.
we look at to test your MBD if you are still a small business.
Okay.
Yeah, yeah. So
Okay.
I think
So
no need to share the slide again.
okay, so that yeah, so that means it's net. So after we've
Yes,
paid
yes.
overhead, we've paid salary expenses, you shouldn't have more than 500K sitting down idle in your corporation accounts. So
It's not,
if
it's not
you
even a, it's not even about sitting down idle. It just means that like what you earn in a year, it's not about sitting down idle. It means that the um in a particular year, if you build if you have a gross income of 750, just ensure that your net income, right, is less than 500. And that can be by increasing your salary or just make sure that you don't ever exceed $500,000, right?
Okay.
But that is when you don't have passive income. If you have passive income, remember, it's no longer 500K. In short, if you have passive income of $150,000 in a year, you are no longer a small business. You are a regular corporation and you pay tax as a regular corporation.
Okay, so I feel that this would come after a financial needs analysis with you because most people, it's not everyone that is moving without maybe dry. Some people might accumulate much more than others, so that can be discussed further with you.
Yeah,
Now,
yeah,
the
yeah.
second one is all life insurance sounds like a sensible option. For someone who has already had life insurance in the UK, like I've mentioned, we all have term insurance. Can we still take this option without canceling the policy already held in the UK? Sounds like what I've mentioned earlier.
Oh, yes, of course, yes. Of course. So yes. Now, when we do a one-on-one, one of the things we check is we calculate your insurable need, right? How much insurable need. And from this insurable need, we'll say, okay, this guy needs $5 million. Now, what does he already have? Oh, in UK, he has 1 million. Okay. So 5 million minus 1 million is 4 million. That means his only insurance gap is 4 million. And this 4 million is what we try to cover. Right? We don't try to, we don't ask, like, I don't advise people to cancel their insurance because you got it when you were young. That means the rates are good. And again, you have assets in the UK. You also have assets in the UK that insurance can also cover. So don't cancel your policy. And it's cheap. You guys have them policies that are very cheap in the UK. So just maintain it and get another one for the gap.
Okay, thank you. All right. Someone said, what is TSFA? So that's the tax-free savings account.
Yes. Yeah. Yeah.
Tax-free savings account. It's just like our LISA. You know, in UK we have ISA, sorry, we have
Yes, sir. Yeah.
20,000 you savings account whereby you can invest without being taxed and then you get whatever benefits for free. All
Mhm.
right. If we leave Canada after 10 years, that's the fourth question. We will still be able to get access to our insurance.
Okay, that's a very good question. Now, as long as you're paying the premiums.
Hmm.
Now, the only problem with leaving Canada is if you leave Canada within 2 years, right? In short, as a matter of fact, if you put in an insurance policy today, most people don't know this. If you put in an insurance policy today and travel to Nigeria next week while it's in underwriting, most likely, if the insurance company knows that you travel to Nigeria, they'll put an exclusion and say, whenever if something happens to you in Nigeria, they will not pay that. So as far as you avoid that scenario of traveling to a country that is on red alert, okay? As if you don't travel to a country that is in red alert, you apply for your policy. Once you apply, it's approved, it's enforced. Once the policy is enforced, just avoid the first 1, 2 years because there's a question in the insurance application that always says, are you do you plan to travel to outside North America and maybe a few New Zealand, something? Did you plan to spend up to 2 months um, out, outside these places within the next 12 months? So you're going to say no to that question. And if you now travel to these places within that 1 year, it means that you will be represented, right? So these are the things you want to look at and be careful with. But then, if you've already gotten the policy is in force, right? And 10 years later, you move to a different country, say Nigeria, where I come from, where I was born, right? Then, of course, if something happens to you, the insurance is going to pay. The
What does
insurance will.
move? What does move mean? Is it after 3 months? Is it away from Canada for 3 months, for 6 months, for 1 year? What's the window?
If the
Well,
policy is in underwriting?
no, no, no. After the policy has been given.
It's okay. After the policy is in force, you
Yeah.
can do what you want to do, right?
You can go for
But
years.
no, 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 no. After the policy is in force, I always advise people anything that will risk your policy. Anything that will put any risk to your policy, just avoid the first 3 years because there's something called incontestability, right? Now, there's a 2 year incontestability period, which means if you declared some things for an insurance company, the insurance company has 2 years to find out if that was a misrepresentation or not. If after 2 years the insurance company did not find anything, then the policy is binding on the insurance company and they are bound to pay. Do you
Mm-hmm.
understand? So so I always tell people just avoid that incontestability period, right? Which is 2 years. But I've decided to notice that some companies in their claim, because it's also good to look at the claim experience, the claim form. The claim form, they would say they are stricter for policies that were claimed in the first 3 years. When I say stricter, it doesn't mean like they will really, it just means that they will ask, okay, attending physician statements, was this guy telling us the truth? Because there's a lot of insurance fraud also. When people come in, they already have a condition, right? They come and get insurance, and all of a sudden, 2 months later, they pass away. So something like that, the insurance company will beam searchlight on it and say, okay, did this guy tell us the truth? But if it is 2 years after or 2, 3 years after, they cannot, they have to pay because they should have found it during the period.
Okay.
Yeah.
Okay. Thank you. Someone said, if your income is less than 250,000 Canadian dollars, should you incorporate, as you may be taxed even while earning little? You mentioned incorporate as soon as you enter Canada.
Hmm.
So I
So,
think she's not ready. I think she's not working so much and
mhm,
okay with 250,000.
mhm, mhm.
Mm.
Okay. So so if you are gonna earn 250K, I know for a doctor, 250K looks like small money. 250K is not small money. It's not small like that. If you earn up the 250K, of course, verify this with your accountant. I'm not an accountant, but I'm just telling you based on my experience in the financial industry. 250K, you can still incorporate.
Okay. All right.
250K is still
So
incorporate.
someone said you offer your services to someone based in British Columbia. So you have a doctor from
Oh
British
yes,
Columbia.
I'm licensed in British Columbia. I have clients in British Columbia.
All
Uh,
right. So
I have clients.
for people who have had life and critical illness insurance from UK, e.g. vitality insurance, is it transferable to Canada? If not, is there a way to make it transferable?
No, it's not transferable. It's not portable. You cannot move it to Canada. But what you want to do is, I think the question you want to ask is, will the policy still cover me while I'm in Canada? Now,
Mm,
I believe that's the question. Will the policy still be in effect while I'm in Canada? Now, um, I'd like you to reach out to your insurance company or look at your insurance document, or we can help you review it if you send it to us. And because some clients also send us their policies, we look at it and say, okay, this is what it means in English. This is what your policy says in doctor's English. Yeah. So yeah, if that's what you mean, if that's the question you want to ask, some policies have restrictions based on where you are. So you need to look at your own policy, ask your own insurer in the UK. Okay.
yeah.
And
Thank
if that
you.
wasn't,
So I would appreciate if we can raise our hands up if we want to ask direct questions. But while we do that, I would run through some of the questions that have been asked before the webinar.
Mhm.
Someone said that can UK insurance policy be transferred to Canada? You just answered that we should speak with them. And then if we don't get enough clarity, we can also give you a copy of our policy for you to do some forensic and
Yeah, yeah, yeah,
explanation.
yeah,
Yeah.
yeah.
So someone said, how does holding corporation for housing work? Can you live in the house?
Okay,
So that's
I will attempt to understand the question and attempt to answer it. But before then, I want to really, there's
yeah.
a question I need to really say something because of the
Yeah.
questions I've heard
Okay.
from doctors. So
Yeah.
in Canada, you can
Yeah.
have more than one insurance policy.
Yeah.
Like in Canada, you can even have five, three, four, two insurance policies, as
Yeah.
long as the total sum insured is less than 25 times your annual income. Okay.
Okay.
So as far as the sum insured is less than 25, you can have more than one policy. Now, for the for holding company, I believe you want to know. So you want to, I believe you want to know if you can use the holding company to own the house you want to live in. That's
Yes.
what I that's what I think you are trying to ask. So for me, this is Charles speaking. I'm not an accountant, but for
Mm.
me, I don't think it makes any sense to buy your primary residence in the corporation. It may make sense in the UK, it doesn't make sense in Canada. And the reason is because your primary residence is the biggest tax break you have in Canada. If you bought your house for $1 million and maybe 20 years from now you want to move back to the UK and you sell it for $5 million, this
Mm.
whole $4 million is your money. You don't pay $1 as tax because it's a primary residence.
Yeah.
Now, if you had this house, if you say, "Oh, I want to own it in a corporation," you put your house inside the corporation.
Mm-hmm.
Now, what is going to happen is that if you want to sell this house in future, it means this house is coming in to the holding company. The 4 million is seen as capital gain into the holding company.
Yeah.
And most times they say to have 5 employees in the company, this money is seen as passive income coming in to the
Mm.
company. That
Mm.
means you have to pay about one point something million. Sorry, you have to pay tax at capital gain inclusion at the prevailing capital gain inclusion rate. So if capital gain inclusion rate is two-third, that means two-third of $4 million
Mm.
multiplied by the passive income rate. So that's not very smart. It's smart for the subsequent properties, the rental property you want to hold, but your primary residence, please, for God's sake, own it personally. It's a lot better. Okay.
Okay, thank you. I think we have some more here. Someone said between universal and whole life, which would you recommend? I think you would want to talk, or which one would you do you want to answer on the spot or you want to talk with her?
Oh yeah. I can answer.
Okay.
So, so there is no blanket answer in finance, right?
Okay.
Everybody Everybody's goals are different. I need to know what your goals are. Why are we getting the policy? How old are you? For example, a 35-year-old guy, right? He's has so many years. The horizon is long, so he can prefer to get a policy that gives him growth, right? That gives
Yeah.
him growth. But someone who doesn't really like a lot of risk, doesn't want to play in the market, doesn't know what they're doing there with stock markets, and prefer to own whole life policies. So it's not like there's one that is better than the other. But
Mm.
if your specific question is
Mm.
specifically asking for for retirement planning
Mm.
or for wealth building within
Mm.
a corporation, or for leverage investing, which is holding the policy and taking money from there, or for
Mm.
using the policy as a bank of his whole
Mm.
life.
Mm.
His whole life. In short, if you want a rule of thumb, if you want a rule of thumb, I'll tell you, rule of thumb, buy a whole life policy in the corporation, okay,
Mm.
and use it for tax play, asset accumulation, retained earnings growth, and or retirement planning. And buy a universal life policy personally, estate planning.
Okay. So
Because that
some
one now, if something happens to you, the money goes straight to your family, not the corporation. So check goes straight to your family within the same month or maybe within a few months, and your
mm.
family can now take their time to do other things while waiting for the corporation one to come out.
Okay.
Yeah.
Okay.
Mhm.
Someone said, can someone do half universal and half whole life?
That's what I've answered that. Yeah, yeah, yeah. I think I've answered that. So the insurable need is $5 million, right? You have 1 million in UK, so the outstanding need is $4 million. Right? In the corporation, corporation, the whole life is not really insurance. It's a retained insurance in the corporation. The main goal is to grow your retained earnings. Since $4 million, you can say, okay, 2 million whole life in
Mr.
the
Charles,
corporate. Yeah.
he's asking that can he combine universal and whole life, not term, universal and whole life together.
If you can have both.
Yes.
Yes, of course.
Okay.
Of course, you can have two
Okay.
universal life, have three whole life, whatever. As far as the total sum insured is less than 25 times your annual income.
Okay. All right.
Yeah, yeah.
All right. Okay, I will come back to these questions. I want to go back to the questions we had before this session.
Mhm.
So someone said, can one pay health insurance policy via the corporation account? I think you've mentioned it as yes, isn't it?
Yes, yes, you can. Health
Yeah, someone,
insurance, health and
mhm.
dental, right?
Health, life or health insurance policy, life or health.
Yeah, life insurance policy, it can be owned by the corporation and paid for by the corporation. Health insurance policy, by the in fact, it's even tax deductible. It's health insurance is even tax deductible to the corporation. So yes, you can own it.
Okay, okay. So it's part of the expenses we can claim before paying tax. Um,
Yes.
Explanation
Even
of the
though,
different insurance policies available. You've done a good job to
even
that.
though, even though
Yeah.
technically it's tax deductible irrespective of who owns it. If the corporation owns
Irrespective.
it, if the corporation owns it, it's tax deductible to the corporation. If you
Okay.
own it, it's tax deductible to you. You understand?
Hmm.
Yeah,
Okay.
irrespective.
Okay. All right. So disability insurance options for those with chronic illnesses that got refused the traditional disability insurance policies. Is getting the every few years option worth it? Is getting the every few years option worth it? That's how the question, I'm just reading it verbatim.
It's getting there every few
So
years.
I think someone, he said, let me read it again. Disability insurance options for those with chronic illness that got refused the traditional disability insurance policies. Maybe the person has been refused some prior insurance, sorry, application. I don't know.
Okay,
Okay,
so
let me frame it
now,
as someone who
but
comes in his
I think I
late 20s.
understand what he's trying to ask, right? I think sort of understand.
Yeah,
So when you are, so when being declined or being postponed insurance
yeah.
is there's actually a skill for dealing with those kind of things. Now, when someone is postponed insurance, I've
Yeah,
had clients who were postponed, as far as the
yeah,
client is patient,
yeah,
postponed all the client, as far as the client is patient, it can sometimes it can take up to 6 months or more.
yeah.
We can find out, we'll write a letter, we'll demand a letter from the insurance company. Insurance company will send a letter to your doctor, telling exactly why it was declined. We find out if it is something that can be remedied, right? Right. If it is something that can be remedied, then we can take through and see if we can make a case for them to approve it. But if they say no and still decline it, then there's another type of insurance for those kind of people called simplified issue insurance.
Hmm.
Simplified. So there are three types of insurance in this aspect. I need to say this because we all need to understand. There is what we call underwritten insurance, underwritten.
Mm-hmm.
There's something we call simplified issue insurance, and there's something we call guaranteed issue insurance.
Hmm.
So underwritten insurance means the insurance company will underwrite and take the risk involved by doing your
Hmm.
medical, taking your lifestyle, and checking your finances.
Mm-hmm.
And then they are working into the contract with full knowledge of the risk. So they are able to size the premium accordingly. That's why it is going to be cheaper, right? Now, because it's underwritten, the insurance company can allow you to buy whatever you want. But if you are not very healthy, or if you have a criminal case, or if you have a lifestyle problem, then you may not qualify for that, and then you go for simplified issue. Simplified issue is another name for no medical insurance. Insurance that they won't do medical. They don't care. If you like, have whatever you have, right? Except some few ones like maybe cancer, HIV, and things like that. Simplified issue insurance, they will cover you. Yes, the only thing is that the coverage is going to be capped. That's the only problem. It's going to be capped. And then if for guaranteed issue is people who have like cancer. If someone is diagnosed of cancer, they can still get life insurance.
Hmm.
But they can only get guaranteed issue insurance, which means it's capped at maybe I think the largest one in the industry right now is for Manulife, $100,000.
Hmm.
$100,000 which is still something, right? And there's a critical illness for those kind of people. This company CPP has what they call I mean, there's a solution for everybody, irrespective
Okay.
of the health status. Yeah.
Okay. And someone said that how do we include our family members in this insurance? So
Which
they
one?
think
Yeah.
it's a question. Let me just read it the way it said.
Mm.
How do we include family in any insurance we are doing?
Okay. So, so I'm gonna answer this question is okay. I'm gonna answer it the way I think the person asked.
Mm.
So, if you buy a personal insurance, of course, your family is a beneficiary. Right? So that's how you include your family. If something happens to you, the life insured, the family gets money. If the same thing, when you buy insurance for your family, so if something happens to your family, you get money. That way, everybody is protected. Right?
Yeah.
That's one. But for the corporation, the way it works is the corporation, the policy you buy at the corporation, irrespective of who the life insured is. And by the way, anybody can be the life insured. It could be you, it could be your wife. Even
Mm.
just by being the spouse of the doctor, there's insurable interest. Right. So if something happens to the spouse, the doctor is not going to be working. He's going to be he's going to be beside his wife on the sick bed, right? So
Mm.
so if you have um so if you have a corporate policy, one of the rules of a corporate policy is that the corporation has to be the beneficiary.
Okay.
Okay? The corporation is a beneficiary. So if something happens to the life insured, the death benefit is paid to the corporation. But now, depending on how you set up a corporation, you can have non-voting shareholders be family members, which means directly they can have a financial gain on the policy. But let's even assume you made the mistake of not adding your family, not a mistake, sorry, you did not add your family for any reason into that corporation as a shareholder, and you're the only shareholder. What happens is that the money, the death benefit is going to flow through to the to your estate. Okay, it's going to flow through to your estate through what we call a capital dividend in CDA, capital dividend account. CDA is a notional account that holds that for anything that is not taxable. So once the death benefit is paid, the portion above the SCB gets passed on to the shareholders of the corporation tax free. But one of the shareholders of the corporation is a deceased. Okay? So that means it's going to get to the deceased estate, and from the deceased estate, from that estate, it can be distributed to the shareholders. Sorry, it can be distributed to the
Family
beneficiaries
members.
of the estate. Yeah. Who
Okay.
are family members.
Okay. Okay. There's the last one. The doctor said health insurance, like give us health insurance options prior to being eligible for HOHIP because he's on work permit.
Sorry, okay. So these eligibilities, I think they've been recently reviewed. And in many cases, you can, I think, except, I hope I'm right. But I think, like the last time I checked, you can be eligible from the one now. It used to be there, but I think they've taken it out now. So you can be eligible from the one. But for there are options for travel insurance because unfortunately, the health insurance in Canada requires that you already have OHIP. The health insurance of these companies that you can buy, one of the first question is, does the person qualify for OE? Yes. So what that person would need is a travel insurance, which we also offer. Right. So that travel insurance will cover if something happens and there's an emergency. And this is not just for you coming here on work permit. So all of us here who are going to bring our parents, to visit or to spend time with the family, you need to buy that travel insurance before you can complete the visa, right? And we do that as well. Um, yeah, so that's typically what the person is going to buy.
Okay.
Yeah.
All right. Thank you. So I can't see any hands up, any raised hands. I would, if you would like to speak with him, if you, the floor is opened. Yeah, so I've got one, Dr. Wifa. Just give me a moment. I don't think you might have to make me the host so that I can give them
Oh,
permission
okay.
to talk.
Can you
Yeah.
imagine? I came and took over. Okay.
Yeah, you are the star of the moment. Yeah.
Mhm.
Yeah. So, Dr. Wifa, I've given
Okay.
you.
Oh, thank
Yeah,
you. Thank you so much. And hello, everyone. Thank you so much for the wonderful presentation.
thank
My
you.
question, first question, I have a few questions, but I'll go first. The first one is this FHSC. I suppose that's the account you open for like first home buying or something, isn't it?
Yeah. It
So
is.
I heard someone say like you cannot open that account if you have other houses anywhere else in the world. For instance, most of us moving to Canada actually have homes in the UK, so that's not gonna be our first home. So does that mean you're ineligible for having that account?
So this is a very good question, right? And there is, for want of time, I would have shown you something on the CRA website. I know sometimes in Canada likes to make things very confusing and unnecessarily complex. Now, if you go to CRA, if you go to the website where it's principal, uh, especially where they wrote that, there is a
CRA
footnote.
website.
No. There is a. You know what? Let me see if I can actually share it now.
Oh,
There's a.
thank you.
Yeah. Let me see. Just give me a second. Even though I've lost the right to share, let me see. Which is eligibility. I want to show you something now. So that's why this question is a very good question for you to discuss with your accountant. Because why am I saying that? Um. So I don't want to be on record for this part.
Okay. Do you mind if you
Yeah.
talk to her
We
Yeah.
personally?
can
Yeah.
do that.
Let
Like
me talk to you.
I
Let me.
booked a
Let me.
one-on-one with you already,
Okay.
so maybe we
Okay.
can talk about that at the one-on-one.
Okay. Let's talk about the one-on-one, right? So let's talk
Okay.
about that on the one-on-one. Yeah. Okay.
Okay.
Mhm.
Sorry
Yeah.
for that. Sorry about that.
No,
Yeah.
no, no,
No, no,
it's
no.
okay.
Don't be sorry. It's just that I want to open up to you and tell you some things that I don't want recorded, right? That's why I'd like to, now if it's recorded, I have to, be careful. But if it's one-on-one, we
Mm-hmm.
can relax and, tell you what I can get recorded saying. Yeah.
Yeah, I've already done.
Absolutely.
Yeah.
Thank you. So,
Yes.
Dr. Mohad, let me allow him to talk. Yeah, the floor is for you.
Oh, hello. Yes, thank you so much, Charles, for all these information. I
You're
think
welcome.
all of us, we are, I mean, I guess I can speak for myself is that I'm not really the most literate when it comes to finance, especially in Canada. So, it's just a question that I was thinking about when you were giving the presentation about the life insurance. So if I understand this correctly, and please correct me if I'm wrong, is that if you have, let's say, a net income of, just to make it very easy, 500,000. And then after the overhead and after everything is paid, 300,000 remains in the incorporation. So are you saying that you can pay 100,000 to an insurance premium every year, and that $100,000 dollars will accumulate over 10 years, and that will be tax free, and you can use that 100,000 after 10 years to invest, and buy property or invest in real estate. Is that what you meant by the premiums?
Yes. So let me. I wish I can share my screen now because this question is better answered with something in front. So what I mean is you can you can convert your whole life policy to the bank where that money is sitting, and it doesn't even have to be. It can be the whole two. It can be 200. It can be three. Whatever you want to do, right? And I want you to, when you get a chance, read the book. It's called "Becoming Your Own Banker." It's by a guy called Nelson Nash. You just buy it and read it, and then it's going to tell you more. But let me answer your question directly. If you open a whole life policy in the corporation and then you set up the whole life in such a way that you can move in $100,000 as premium every year to the policy. Now, that money sits in the policy and compounds within the life insurance policy. Now, that compounding continues until even beyond until you pass away. It's just going to keep compounding. That's one part of the question. Yes to that. But to the part of taking money from there by either leveraging, withdrawal, or by leveraging and withdrawal, leveraging is the one I recommend. You can take money from that policy, but the only difference between reality and what you said is that you don't have to wait for the year 10 to do that. You can take money out of the policy even in the first year. In fact, you can do what we call immediate financing arrangements, where you take 100K from the corporation, put in the policy, and then borrow the money from the policy and put in the investment. You understand? It's just like having a house. Think of it like a house. You have a house, the house has an equity of $100,000. You can take the house to the lender and say, hey, I have this equity of 100K. I need to invest 90K. Please give me 90K loan using this house as a collateral so I can pursue an investment.
Okay, I think I understand. So you borrow against the money that you have in the policy.
Yes.
So let's say that.
Yeah. But you can also withdraw if you wanted to. I don't recommend withdrawal. I don't recommend withdrawal, but you can also withdraw. But the better way to do it is to allow the compounding to continue in the policy. They use the policy as a collateral to borrow money because it's a secure loan by specific companies, right? The interest is super low, maybe like 5%. It's like 5 or 6%, 5 point something right now percent, because it's a secure loan. And then that loan, you are not under obligation to pay. You can decide you want to pay every month. You can decide you don't want to pay at all. You don't want to pay the interest. You don't want to pay the principal. That loan just stays there until when you get old and pass, your death benefit is going to pay off the loan.
Okay. So that's how they get their money. Is that what?
Yeah. Correct. Correct. Yeah. They know you're gonna pass away, so it's certain. So again, money from the corporation you put in whole life. Then from the whole life you borrow money to put in anything, any investment, real estate, ETF, whatever.
You don't pay it.
You don't pay what? You don't pay?
You don't pay the loan that you borrowed against.
You don't pay the loan. You don't pay the loan. You can decide whatever you want to do. You are the boss. You can decide you want to pay the interest only. You can decide you don't want to pay anything until you get old. Then your death benefit pays off. Or if you want to be even smart, if you want to be smart, you can decide to pay the interest. And guess what happens? If you pay the interest, two things happen. The interest becomes a tax deduction that lowers your tax in the corporation. And also, the pure cost of insurance lowers the tax in the corporation. So overall, you are just getting tax deductions everywhere. And if you now look at the effect of that tax deduction on the loan you took, maybe you're taking $1 million loan at 2% interest or something ridiculous, 2 or 3%. It's amazing. So if you have the way to invest money to be like 10%, don't take money from your company and put there. It's not America. That's not smart. Take the money, put in whole life, take in whole life and put in that investment. Right? Just keep doing that and put in that investment. That way you are getting on both sides. Now, I know this is going to take time, but let me just share an analogy that helps my clients to really understand this. And then can I share my screen, please?
Yes,
it's an
you
analogy
can.
that aids understanding very well. Okay.
Yeah, you
Let's
can
see.
go ahead. Go ahead.
I can't share. Say the same thing.
Yeah, go ahead.
Okay, now, okay. So let me show you an analogy that always helps my client to understand this. So let's use real estate analogy. You have a house, the rental property. And this, let's say this house, the fair market value, if you were to sell it today, is $1 million. But the mortgage on the house is 500K. How much is the equity?
500.
Beautiful, 500K.
Yeah.
Now let's assume two things. Let's assume that in this house you have tenants living in this property, and these tenants pay you 50K per year. And now let's assume that this property appreciates at, let's use a rough number, 10% per year, right? But then you need some money to invest in, and you need maybe $400,000. That's your need to invest in another business that just came up. And this is what billionaires do. You have three options to get that money. Option one, you can sell this house, pay off the mortgage, take 500K, put 400K in this business and keep the 100K. But that option means that you stop getting 50%, 50K per year, and you lose out on the annual appreciation. Option one is sell. Option two is you remortgage or cash out refinancing. That's what we call it here, where you refinance the house and pull out equity. Okay? So if you refinance this house and pull out equity of 400K, the problem with that is that you're just spinning the wheels of the bank. You're just making the banks, make profits because you go back to start the interest again and be in the high interest zone where you're just most of your mortgage is paying interest. Now, the third option is that you can take this house to a bank and say, hey, Mr. Banker, I need a home equity line of credit. I need a loan that is going to be backed by the equity I have in this house as collateral. So can you lend me 400K at 5%? At 5%. Now, that doesn't make sense because I'm giving this guy a house as collateral. He's giving me his money at 5%. Meanwhile, my house is appreciating at 10%. So this appreciation of 10% minus the loan I'm paying at 5% already means that I'm 5% better. That's number one. My house is appreciating at a faster rate than the interest I'm paying. Number two, getting 50K every month on top. I'm still getting the rent every month without interruption. And then number three, I still have the assets. I have this asset and I also have this business. I don't have two assets. I'm missing out on the other one. So number three, I still have the assets. And then between these two, with these three options, which one would you rather do?
Number three, obviously.
Exactly. Because even this interest on number three is tax deductible. That helps you lower your taxes. Right? Yeah. So this is exactly the way this play works. This house is the whole life policy. This rent is dividends you're getting every year. Because when you buy whole life policy, you are also buying a part of the company. So you are a part owner of the company. You can actually attend annual general meetings. So the company declares dividends and they pay. They pay. Now, the thing is, this the rent is a dividend. This whole life. Then what else? What else? What else? Um, the what else? What else? What else? What else? So yeah. So now you are able to. The house is the whole life policy. You are able to leverage money from there to pursue that investment, and the appreciation is the compounding that is happening in the whole life policy. Is the compounding that is happening in the whole life policy. It is the interest that you're paying on the loan you're taking, and this capital you don't have to pay it back. Your death benefit to pay it back. So you're not bothered. You just worst case, you just keep paying the interest because of the tax, the fact that it lowers your taxes, and then when you get old and pass, the death benefit settles it. That's how it works.
That's very clear. Thank you so much. So basically, whatever money you have in the incorporation doesn't make any sense to take it out. I mean, unless you're giving yourself a salary or dividend, the rest should always be there, remains there, should never be taken out because you can always borrow against that money that you have in your corporation and do whatever you want in terms of investment.
If you understand whole life very well, you are going to be a lot better ahead because they like it has too many advantages. This is one, it can help you, your money resides there in a place where there is full safety. If the insurance company were to go under, you get assurance gives you 90% of your money. If the money was in the bank and the bank goes under, it only gives you $100,000. The rest is gone, right? But then, so you keep the money in a place where you have, and there's something else I need to also show you guys that we don't talk a lot about. Yeah. Now, if you see this, this is you putting 100K every year. Just keep it here. If you need the money, you take it out and do whatever you want to do, whether as withdrawal, but better as a loan. But now, let me ask you a question. If at year 10 this year you had the money in your bank account and you passed away, your family only gets $1 million less the taxes that will be due, maybe 400K in taxes, and they only get 600K. But if you kept the money in whole life and something happened to you at that point, family gets $5.5 million. So I always say that any corporation owner, not just doctors, any rich folk who doesn't use whole life to grow money and use whole life as a place to reside their money doesn't understand it. Then you understand it very well, then you will understand that that is the best vehicle you have because it doesn't stop you from pursuing other things. So all some people say, no, I don't want to do whole life because I want to do real estate. No, I don't want to do ETF. No, that's not it. Do whole life, take money from whole life and pursue other investments abroad, in Canada, in the US, whatever type of investment. And if that investment is income generating, that income is going to you keep more of the income because you have the interest and the net cost of pure insurance that has helped you lower your taxes. So that's the way it works, right? And this just continues to compound. You can use it, you can access it anytime. Unlike RRSP, where if you put money in the RRSP, you can only access it once when you want to buy your primary residence. Outside that, you can only access RRSP when you're old, when you're very old, right? And you want to have that flexibility to be able to touch the money, to use your money if an investment was to come up. And whole life gives you that. Yeah.
All right. Thank you so much.
Thank you.
Yeah, I think we have. Thank you, Dr. M. Muad H. Someone said we would like to know too. Okay, it's not a question, it was just a comment.
Yeah.
Yeah, I think we have exhausted our questions and you've gone through everything, and we still have the opportunity of talking one-on-one with you.
Mhm.
In the absence of no other question, I will wrap it up and call it a day. Thank you, doctors, for showing up. I've put in the link in the WhatsApp group where we all converge. Please, Mr. Charles, if you can put up your link again, the
Okay.
QR
Okay.
code and your number,
Okay.
that would be helpful.
Okay. I'll do
Particularly, yeah. There's just one question I wanted to ask, which is that first 90 days thing to do
that.
regarding health insurance. So I've learned about a doctor who came in, not a doctor, someone came in and needed to use the health system within the first 90 days and was slammed with a big bill. So I don't know if you have anything to say about what we can supplement with OHIP when OHIP kicks in and what we can do regarding our health or to protect ourselves and family. Do you also help with health insurance?
Oh, yes. Okay. Oh, okay. That's true. Please, thank you for saying this. So let me use this opportunity to actually mention everything I can help with. But just give me a second. I'm trying
Okay,
to.
you're looking for that last slide.
Yeah. Just give me a second. Um,
So you need to share your screen.
yeah.
Your
I'll do that. Okay. Right, my system is hanging. So, oh yeah, okay, I'm here now. Okay, Zoom, share the screen. Okay, I'm here now. Can you see my screen?
Yes, I can see your screen.
Okay, so let me go.
Yeah.
So now, so just to mention everything that I offer, I do health insurance. I do travel insurance. I do this kind of insurance you're speaking about with three companies, Manulife, Travelers, and Remy. And to be honest, when it comes to insurance, we shouldn't really take chances because in other countries you can take chances, but in Canada, healthcare is crazily expensive. And the way you know that healthcare is expensive is by checking how much doctors are earning. The fact that you guys earn so much, already tell you, right, that healthcare is not cheap in Canada. So you don't want to take that risk and expose your asset. But just to give you guys a sense of everything I offer, life insurance, everything that looks like life insurance, critical illness, everything that looks like critical illness, disability insurance, health insurance, commercial insurance, pet insurance, travel insurance, anything that has insurance, commercial, anything insurance, I do it. We do it.
Can
Okay?
I ask a question?
Yeah,
Sorry for
yeah,
interrupting. You
yeah,
see this,
good.
you see this cocktail you've given us? Can
Yeah.
we take a little bit? Is there any package that involves a buffet where I come and shop a little of disability, a little of critical illness, a little of whole life, a little
Yeah,
of
yeah.
travel, and you package it and make my own cocktail for me alone? Is it
Oh, yeah,
possible?
of course. Of course, of course, of course,
Really?
of
So I don't
course.
have to pay for insurances and be doing for underwriting. I just pick what I
Oh,
want.
yeah.
And
So,
because I have
yeah.
critical illness from the UK, I
Mhm.
have term insurance from the UK. So, and I know my health status. Of course, I can't predict my risk. I might not necessarily, I have some little investment here and there. I might not necessarily need so much, but I want to transfer wealth to my children. I also want to pay the permanent one for my kids. I want to give them that wealth transfer. That one is very attractive to me. The with as little as $200, and I think I can pass on something substantial to my girls. Can I pick little, and you make a cocktail specially suited for me, so that I will pay maybe like a premium that would cover everything,
Yeah,
not
yeah.
premium here and
Oh
mm,
yeah, that so yeah. I mean, there's we can do something like that, but you know what? Let's discuss it in because when we discuss, we don't rush to give. We just want to sit down, and listen to you, know what you want, know your goals, know where you are, what you already have, and then we can actually, because sometimes what you're asking us may not be the right one for you, may not be what actually suits you. And then we can now tell you, okay, this is what suits you. And then, but everything is after. Do you know that if you actually want, you know that, like, people don't know this. Do you know that if you actually come and tell me, I want to buy insurance of $10,000 a month,
mm,
you know that as per my license and the regulators, I'm expected to do a needs analysis to see if your discretionary income can afford it. So I can turn you down and say, no, you can't afford this. You're going to struggle to pay for it. So let's cut it down to this. So when we have the one-on-ones, when we sit down, we'll look at what can be tailor-made for you. But I want to also, your question made me remember something very important based on experience. Now, so one mistake people make, so something that you can also do when you do when you put in an insurance policy,
mm,
it makes sense to do the all the insurance you need to do, right? Because if you do one insurance today, by next month when you apply, they are going to run a scan on all the policies you've done through what we call the Medical Information Bureau to see if the declaration you are making to them is different from what you've declared to another insurance company. So there are some skills required to ensure that one increases his or her chances of approval, right? When a policy is put in. And this is very important. That's why when it comes in, I always tell doctors, when you come in, insurance is the first thing you sort. Just tell me what the budget is. We can do something that can be upgraded later, because some insurance are convertible. They can be exchanged for something else. They are exchangeable. Some are convertible that you can convert to something else. It's better because by the time you come here, you start going to see the doctor. Oh, I want to do sleep study, sleep apnea. By the time you start, seeing the doctors too much here, you can increase your chances of becoming uninsurable, right? And you don't want that to happen. That can actually do happen. Or maybe they will say things like, oh, Dr. John Doe, we noticed that you saw a doctor from your attending physician statement. You saw a doctor, and the doctor said you should do a test. We're not going to cover you. We'll postpone it until you do that test. Right. Even if it's for something so mild, once there's an open investigation, they will not touch it until that's completed. So insurance is something to really prioritize fast, right? And ensure that you work with someone competent. It is I can't, it is very important, right? So I hope I answered the question. Then the other part of the services I offer is on the investment side, right? We'll help you set up the TFS, FHS, RRSP. We can even help you set up a corporate health ETF, corporate health investments, right? And manage the portfolio and make sure it makes good returns. Because we have some, like the returns I'm able to make, you can never do it DIY because there are some things that you have a full-time job. This is my job. This is all I do for a living, Monday to Sunday, right? So it can't be the same. Now, I have a fund. I was telling a client the other day that he was telling me, wow, I put my money in at NASDAQ 100, S&P 500. I said, do you know that last year, TD Bank did better than NVIDIA? You know that Canadian equity last year decimated American equity, right? Canadian small cap stocks, this Canadian small cap did 40 something percent last year when NASDAQ 100 was struggling. So there are some things and also you won't understand how to tie your 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 financial goals to your horizon and to the and of course to the resources you have. But we, with our job, right? I can say, okay, he's telling me to invest money for his kids' education. This kid is 15 years old. He's going to be in college in 2 years. So the way I invest for that kid is different from the way I would invest for a 2-year-old kid who is going to be in college maybe in 15 years. The horizons are different, right? And we look at different risk profiles. So your finance is so peculiar. You want to sit down with a professional who is really good at what he does and who can make sure that what they are doing for you is tailor-made for you. And when that is done, don't make the mistake of going to say, oh, but my friend has this. I don't have it. It was tailor-made for him too. It was tailor-made for him too. It was tailor-made for him too. So, no, it would be really nice to work with most of you. And there's something else we also do. I hope I can share that a day. So, because we have so much passion, the passion is not to have a successful business. The passion is to have clients who are going to be on Forbes list eventually, right? So we are very passionate. That's why I'm here on a Sunday, right? I should be with my children, but I'm very passionate about this, about what I do, and I put in real good work to research, to study, to make sure I am up to date and give you the best service. And then we do something else for children. We do every summer. We do financial literacy for kids, right? And those events, the goal is that we want to, as we're educating the parents, working with the parents, we also want to work with their children to ensure that they are also learning. The goal is 10 years from now, 20 years from now, we are going to have a bunch of kids who all come from wealthy families, who all have good financial knowledge, who all have friends who are like them. Imagine how explosive that can be. So please, let's work together. Let's um let's see how we can fit into your plan. If there's anything we can do to support you, and then hopefully you are going to achieve your financial goals.
Amen. Thank you so much. Yeah,
Yeah.
thank you, doctors. It's been 2 hours in now. I want us to go and have a good evening and rest. Prepare for tomorrow. Yeah, so we'll catch up with him. He works 7 days a week. Happy to talk to you whenever you are. Um, I will wrap up now. Yes, thank you, Mr. Charles, again. I'm sure you're going
Thank
to be busy in the next few weeks.
you. Thank you very
Yeah.
much.
All right then. Take
Uh,
care.
take,
I'll
take
be,
care.
yeah, I would be putting this on our I usually put it on our YouTube link for other doctors. We are almost 400 in the group. So like 10% came in today. So
Mhm.
a lot of them would go work. Some of those are at work and they've told me that they would watch it. So they would
Mhm.
definitely get in touch with you too.
Okay. Thank you
All
very much. I really enjoyed my time. This is a very good. Actually, doctors, before I used to think doctors, they study so much, they're gonna be boring. Until I started working with doctors, and I'm like, oh God, how
Yeah,
are these people so smart
we are
and
just
yet
busy. We are not
so
boring.
unserious? You guys are fun, man. You guys
Yeah,
are so fun, so much fun to hang out with. So thank you very
yeah.
much, guys, and have a wonderful rest of your day.
And you too. Bye. So
Bye
you
bye.
cannot sign out. I will just wait and usher everyone out one after the other. Or should I just end the meeting?
Thank you so much.
Thank you.
Yeah.